The U.S. debt crisis, the shaking of a global pillar. Recently, the U.S. experienced a significant financial shock, with U.S. Treasury bonds, long seen as one of the world's safest assets, being aggressively sold off. According to reports from foreign media, Wall Street elites are more pessimistic about the future of the U.S. economy than they have been in a long time. The trigger for this upheaval was President Trump's announcement on the 2nd of April regarding reciprocal tariffs, which set off a rare and historic drop in the stock market, Treasury bonds, and the U.S. dollar. By the 11th of April, the yield on the 10-year U.S. Treasury bond briefly broke through 4.5%, and the U.S. dollar index hit a record low since the COVID-19 pandemic began. While most people focus on the stock market, this financial turbulence is reminding the world that U.S. Treasury bonds are the true backbone of the U.S. financial system. On the 14th of April, former U.S. Treasury Secretary Janet Yellen warned China against selling off U.S. debt. On the 16th of April, Federal Reserve Chairman Jerome Powell stated that the Federal Reserve is facing a situation it hasn't encountered in more than 50 years. What's happening with U.S. debt, and why could it potentially cause the collapse of the dollar? In this article, I will explain, in plain language, the relationship between U.S. Treasury bonds and the dollar. To understand this connection, we first need to explain how the dollar is issued. Many people mistakenly believe that the U.S. Treasury can simply call the Federal Reserve and say, "Print me $1 trillion." The Treasury then issues $1 trillion in bonds, and the Federal Reserve starts printing the dollars to match. However, this is a misunderstanding of financial principles. So, what is money, or currency, really? Many think that money is just printed by banks, so they assume banks are the richest institutions. In reality, banks only control the paper. The true wealth behind that paper belongs to the people. Let's consider an example. Suppose a hardworking bakery owner earns $10 by selling snacks and takes that money to the bank, exchanging it for a promissory note worth $10. The $10 in coins becomes the bank's asset, and the promissory note is a form of debt owed by the bank to the bakery owner. Therefore, money is essentially a form of debt, a promise to pay. On a central bank's balance sheet, liabilities include the currency it prints, while assets include collateral, which could be things like gold, silver, or bond. These assets are the foundation of a currency's credibility. If a currency is printed without adequate collateral, it risks becoming worthless, leading to hyperinflation. For instance, imagine the bakery owner tries to exchange that promissory note for dollars, only to find that the $10 note is now worth just $2. That's a devaluation of 80%. Others, seeing the bakery owner's predicament, rush to the bank to exchange their notes for dollars, triggering a bank run. This kind of financial chaos illustrates the deep connection between money issuance and government debt. This is the underlying logic that ties U.S. Treasury bonds and the U.S. dollar together. Every country's economy is different, so their central bank's assets vary. For example, in China, because it's a trade surplus country, over 50% of the central bank's assets are foreign exchange reserves, about 30% are domestic loans, and less than 5% are government bonds. Additionally, there are some gold reserves. Foreign currency reserves in large part serve as collateral for the Chinese 7 RMB. This part of the money is called the foreign exchange reserve backing. Let's say the exchange rate of the Chinese RMB to the US dollar is 7-to-1. When a business comes to the bank, for every dollar of foreign exchange, the central bank prints 7 RMB, injecting that amount into the market. The balance sheet reflects a $1 asset and a 7 RMB liability. But because China has accumulated so much foreign exchange, printing RMB and letting it flood the market could lead to runaway inflation. To control this, the central bank uses tools like required reserve ratios and central bank bills to lock away excess currency and control its circulation. In practice, this means that every time the central bank prints yuan, it doesn't just release it into the economy. It controls the money supply carefully to prevent inflation from spiraling out of control. This mechanism is similar to how the Federal Reserve works with the U.S. dollar and U.S. Treasury bond. Now, let's turn to the Federal Reserve's financial structure. As of June 2024, the Federal Reserve's total assets were about $7.2 trillion. Of this amount, $4.8 trillion, roughly 67%, consisted of U.S. Treasury bonds. Another 32% was in mortgage-backed securities, MBS, and the remainder included about 8,100 tons of gold and other assets. The bulk of the Federal Reserve's assets are tied up in Treasury bonds, making them the cornerstone of the U.S. dollar's value. The reason this structure exists is due to the U.S.'s long-standing trade deficits and the absence of substantial foreign exchange reserves. The U.S. doesn't have enough gold in its reserves to back the dollar, so U.S. Treasury bonds have gradually become the collateral for the dollar. In summary, Treasury bonds and the U.S. dollar are inseparable. If Treasury bonds collapse, the dollar follows. But how did Treasury bonds come to serve as the primary collateral for the dollar? From the late 19th century until 1971, the dollar was backed by gold. But why did the U.S. abandon the gold standard and move to Treasury bonds? At the time the Bretton Woods system was established, the U.S. held 3/4 of the world's gold reserves, which were used to back the dollar. However, by 1971, the U.S. gold reserves had shrunk to less than 20% of the global supply. With such a small proportion of global gold, it was no longer feasible for the U.S. to continue backing the dollar with gold, as this would cause the dollar to collapse. So President Nixon decided to decouple the dollar from gold. But what would replace gold as the dollar's anchor? It wasn't oil, as some might think, but rather U.S. Treasury bonds. The mastermind behind this new U.S. dollar system was Paul Volcker, Nixon's Deputy Secretary of the Treasury and the architect of the breakdown of the Bretton Woods system. Volcker's inspiration came from his mentor, Robert Russa, who had served as a Deputy Secretary of the Treasury under President Kennedy. Russa's most famous idea was that because the U.S. was the most powerful country in the world, the dollar should be the world's reserve currency. In the 1950s and 1960s, Russa proposed that the U.S. government issue bonds with high interest rates to attract European buyers. By purchasing U.S. Treasury bonds with U.S. dollars, Europe would no longer demand to exchange their dollars for gold. The concept of debt monetization was not without merit. As long as the government had the ability to repay its debts, it could stimulate the economy through borrowing. This approach was similar to what the Red Army did during China's revolution, issuing bonds to support its economic development in its base areas. The bond-based approach allowed China to establish a strong monetary system, much like how the U.S. sought to strengthen its own financial structure with bonds. In 1979, when Volcker became the chairman of the Federal Reserve, he expanded on Russa's ideas. Not only did he encourage other nations to buy U.S. Treasury bonds, but he also pushed the Federal Reserve to increase the flow of dollars by buying and selling bonds. Under this framework, U.S. Treasury bonds gradually became the invisible collateral for the dollar. The reason they're considered invisible collateral is that U.S. law does not explicitly mandate the Federal Reserve to hold any specific type of asset. According to Section 14 of the Federal Reserve Act, the Fed can hold assets like government bonds, mortgage-backed securities, and other eligible debt instruments. Treasury bonds can serve as collateral, but they aren't a requirement. Yet, under Volcker's system, the demand for Treasury bonds grew significantly, and their credibility was greatly expanded, effectively making them the anchor of the dollar. However, this global monetary system came at a cost. The U.S. had to begin exporting its dollars, which transformed the country into a trade deficit nation and a consumer economy. The first year the U.S. ran a trade deficit post-World War II was 1,971, and that year also marked the beginning of the decline in American manufacturing. By 1980, when Volcker became the Federal Reserve Chairman, the U.S. trade deficit started to explode, and manufacturing continued its decline. As globalization deepened in the 21st century, the need for more dollars grew, exacerbating the trade deficit. So, did the U.S. suffer from this? Not exactly. The Federal Reserve could artificially increase or decrease the attractiveness of Treasury bonds by adjusting interest rates, which allowed it to control the flow of dollars globally. This allowed the U.S. to shift the cost of domestic crises onto other nations, all while profiting from the global demand for U.S. Treasury bonds. As inflation hit the U.S., the Federal Reserve began to raise interest rates, which in turn boosted the yield on U.S. Treasury bonds. This made these bonds even more attractive to global capital, causing money to flow back into the U.S. in search of high-yield, low-risk investments. However, the capital flight from developing countries caused by factors like foreign exchange rate fluctuations began to deplete their foreign reserves, making it impossible for many of them to afford U.S. bonds. This led to recessions in many developing countries. Meanwhile, the U.S. gradually controlled inflation, and once foreign assets had reached rock bottom, the Federal Reserve entered a cycle of lowering interest rates, which caused the yield on U.S. Treasury bonds to drop. At this point, the U.S. government took advantage of the low interest rates to issue large amounts of long-term and ultra-long-term Treasury bonds. By locking in low borrowing costs for many years, the U.S. was able to increase its debt without facing an immediate increase in interest payment. These bonds, once issued, converted into a flood of cheap dollars that flooded into developing countries to buy up distressed assets. During these periods of interest rate cuts, while it appeared that foreign investors were earning substantial returns from holding U.S. dollars, they didn't leave the money idle. Instead, much of it found its way back into U.S. Treasury bonds. Even when bond yields were low, U.S. bonds were still seen as more stable than holding cash. For example, between 2008 and 2014, during a period of low interest rates, the 10-year U.S. Treasury bond yield fell as low as 1.8%. Despite this, the U.S. government issued $1.8 trillion in 30-year Treasury bonds and $7.5 trillion in 10-year bonds. Of the total, $4.8 trillion in ultra-low interest long-term bonds were purchased by foreign buyers. In the next interest rate hike cycle, some countries that were financially strained were forced to sell off U.S. Treasury bonds. However, by doing so, they had to cover the difference in interest rates, essentially selling bonds at a loss. When the yield on U.S. bonds was high, countries didn't have enough excess dollars to buy them. But when they finally accumulated enough dollars, the bond yields had dropped. This cycle made it increasingly difficult for many foreign buyers to find a profitable exit strategy. This is how the U.S. has used Treasury bonds to maintain its global currency dominance. But is U.S. debt really as reliable as it seems? While the U.S. prints a massive amount of dollars through issuing bonds, it is able to attract those dollars back into the system through interest rate hikes. The U.S. can continue to issue new debt to pay off old debt, essentially keeping the system going. However, there are significant risks on the horizon. One of the main reasons the U.S. faces declining confidence in its debt is the persistent fiscal deficit. Since 2001, the U.S. government has been spending excessively, but much of the spending has not been used to develop productive capacities. Instead, it has fattened the financial and military-industrial complexes. The middle class, which contributed the most to tax revenues, has seen its wealth shrink, leaving many people nostalgic for a time when the U.S. was more economically vibrant. But the U.S. government has been reluctant to tax corporations and the wealthy, which has led to an imbalance in contributions to the country's tax base. Despite efforts to curb spending, the U.S. fiscal deficit continues to rise, and national debt piles up. Concerns are growing that the U.S. may not be able to repay its debts, which is weakening the creditworthiness of Treasury bonds. Another factor eroding the credit of U.S. debt is the frequent abuse of financial sanctions. Treasury bonds are a key part of foreign exchange reserves for many countries, and governments purchase U.S. debt because of its liquidity and security. However, the U.S. has a history of using its financial dominance to freeze foreign exchange reserves or threaten countries, such as Russia, Iran, and even China in the 1950s. These sanctions may produce short-term effects, but they ultimately undermine the trust in U.S. debt. As a result, countries have quietly begun to establish their own currency settlement systems, bypassing the SWIFT network and reducing their reliance on the dollar. This trend has led to a decrease in global demand for U.S. Treasury bonds. As a result, the price of U.S. debt has started to decline, raising the cost of issuing new debt. If this trend continues, the U.S. will find itself unable to issue new debt to refinance its obligations, ultimately putting the entire dollar system at risk. The situation with U.S. Treasury bonds has reached a critical juncture. Many countries simply cannot bear the Federal Reserve's aggressive interest rate hikes, which have sparked a series of financial crises in the past. The Fed's interest rate adjustments have triggered major economic disruptions, such as the 1980s Latin American debt crisis, the 1997 Asian financial crisis, and the 2008 global financial crisis. In each of these instances, countries saw their wealth wiped out in a matter of years. Many nations, now wary of being caught in the same trap, have started implementing capital controls to prevent the dollar from flooding their economies. The rising interest rates are also straining the foundations of U.S. debt. Treasury bonds, once seen as a cornerstone of global financial stability, are now increasingly viewed as a risky asset. This is because the U.S. is no longer relying on a robust, healthy domestic economy to support its debt. Instead, it has come to depend on speculative methods to reduce its debt burden. Despite claiming its independence, the Federal Reserve often works in tandem with the U.S. Treasury Department and hedge funds to artificially inflate bond prices, creating a false perception of high demand. However, other countries are not blind to this manipulation and can see the underlying weakness in the U.S. fiscal situation. As a result, from 2011 onward, central banks across the world began to quietly sell off U.S. Treasury bonds. China, for instance, has sold around $500 billion in U.S. debt since 2015. The Bank of Japan, under significant pressure from the U.S., also began selling off over $200 billion in 2022. Russia, too, started eliminating its holdings in U.S. debt in 2018, selling off more than $170 billion. In 2011, foreign buyers accounted for half of the U.S. Treasury bond market. By 2024, this number had dropped to less than a quarter. The majority of U.S. debt is now held by the Federal Reserve and the U.S. government itself. The foreign buyers still purchasing U.S. bonds include Japan, China, the U.K., and Luxembourg. But it's important to note that countries like the U.K. and Luxembourg are often used as financial intermediaries, meaning the bonds they hold may not be for their own use, but for other nations. In essence, the real foreign buyers of U.S. debt are those countries running trade surpluses nations like China, Japan, and others. This isn't a conspiracy, but a fundamental aspect of the U.S. debt and dollar ecosystem. A country with a trade surplus generates more dollars, which it then uses to purchase more U.S. bonds. This dynamic is critical because as countries reduce their trade surpluses or shift away from U.S. debt, the foundation of the dollar system begins to erode. The collapse of the trade surplus market for U.S. bonds would mean the destruction of the dollar's foundation. Trump's aggressive tariffs, particularly those aimed at surplus countries, could be the trigger that sets this collapse into motion. It is a classic case of a policy that satisfies a nation's short-term needs but overlooks its long-term consequences. By forcing trade surplus countries into a corner, the U.S. risks losing the very foreign buyers that keep its debt machine running. If foreign investors start selling U.S. Treasury bonds en masse, the global economy will experience an intense shakeup. The risks of this happening are becoming clearer. Foreign investors are already showing signs of pulling away from U.S. bonds, and if the U.S. continues down this path, it could ignite a debt crisis of unprecedented scale. Should this happen, the consequences would be dire not just for the U.S., but for the global economy as well. The market's growing fear of serious inflation in the U.S. has caused capital to flow out of the country and into gold and the euro, among other assets. Some players, known as bond vigilantes, have begun selling off bonds as a way to warn the U.S. government. If you continue with these reckless policies, we will trigger a debt crisis. This may seem like a radical move, but the intention behind it is to force a correction before things spiral out of control. So, who is behind the massive sell-off of U.S. Treasury bonds? Many analysts initially believed that China might be the culprit, as selling U.S. debt would lead to a devaluation of the dollar and a strengthening of the yuan. However, it is unlikely that China would take such a step, as it would hurt its own economic interests. Instead, reports suggest that Japan might be the key player behind the sell-off. Japanese financial analysts, examining the trade activity around the 17th of April, the date of the U.S.-Japan talks, speculate that Japanese institutions may have been behind the sell-off. The Japanese opposition party has even suggested using U.S. Treasury bonds as leverage to pressure the U.S. in negotiations. Regardless of who is behind it, the large-scale bond sell-off has led to a significant plunge in Treasury bond prices, causing turmoil in financial markets. This has led to the most extreme scenario, the belief that if Trump continues with his policies, the final showdown will come sooner than expected. Ray Dalio, the founder of Bridgewater Associates, has warned that Trump's trade war could lead to a crisis far worse than the 1971 collapse of the monetary system or the 2008 financial crisis. Dalio, a deeply knowledgeable observer of historical debt cycles, has accurately predicted past crises, including the 2008 financial crash. His analysis suggests that the collapse of the U.S. Treasury bond system could result in the disintegration of the existing dollar ecosystem, plunging the world into a global recession and potentially even triggering a third world war. This scenario may seem far-fetched, but it's not without historical precedent. The Great Depression of 1929 to 1933 led to World War II, a lesson in how economic collapses can trigger global conflict. The fundamental issue is that countries buy U.S. debt because they are all tied to the dollar system, needing the liquidity that the dollar provides. If the surplus countries stop buying U.S. debt, the system will collapse under its own weight. Trump's aggressive trade policies have hit surplus countries hard, and while this may stroke his patriotic pride, it is clear that the ultimate outcome is uncertain. The new bonds that are issued under these policies will be taxed with steep tariffs, leaving countries like Japan, the European Union, and China reluctant to buy. Even though U.S. debt is seen as a relatively safe asset, these countries have little incentive to continue purchasing it under duress. If foreign investors do eventually pull out completely, with the total foreign-held U.S. debt of $3.5 trillion being dumped, the market will be overwhelmed. The collapse of the U.S. Treasury bond market will trigger massive global inflation, a severe economic downturn, and the unraveling of the dollar's dominance. The world will enter a period of painful recalibration. The day the U.S. trade deficit reaches zero could be the day the U.S. loses its ability to control global finance. As countries stop buying U.S. debt, the dollar will lose its status as the world's reserve currency, and the U.S. government will no longer be able to borrow freely. The game of borrowing and printing money will come to an end. With America's relative decline in power, the decline of U.S. debt and the dollar is an inevitable consequence. As Adam Smith said in The Wealth of Nations, labor is the real measure of the value of all commodities. All wealth is essentially purchased with labor, not with gold or silver. When the final showdown happens, a new order will be established. The U.S. will likely have to rebuild a new dollar ecosystem, potentially including new assets like Bitcoin to back its currency. Meanwhile, China could, just as it did in the early years of its founding, link the value of the yuan directly to productive capacity, such as the total energy output or manufacturing value, making the currency completely independent of foreign currencies. As we reach the final analysis, the reality of the U.S. debt crisis becomes clearer. If the U.S. continues its aggressive trade policies, especially targeting surplus countries like China, Japan, and the European Union, the consequences for the global economy could be disastrous. The immediate problem is the ever-increasing fiscal deficit, which has been rising steadily for decades. This fiscal irresponsibility has caused many to question the future of the U.S. dollar, especially as foreign demand for U.S. Treasury bonds diminishes. The U.S. has long relied on its ability to issue debt in its own currency to fund its deficits. This has allowed the U.S. to run up an enormous national debt, yet continue borrowing with relative ease. The issuance of U.S. Treasury bonds has been crucial in maintaining the dollar's position as the world's reserve currency. But this system is built on a delicate balance one that is now facing serious challenges. If the U.S. continues to pursue policies that alienate its key trading partners, especially those with large trade surpluses, it risks undermining the very system that has supported its financial dominance. Countries like China and Japan have been crucial buyers of U.S. debt, and any significant reduction in their willingness to buy U.S. Treasury bonds would send shockwaves through the global financial system. The question is, who will pick up the slack if these countries stop buying, and at what cost? It's also important to understand that the U.S. is not just losing foreign buyers of its debt, it's also losing global trust in the dollar itself. As nations around the world begin to de-dollarize, the demand for U.S. dollars and U.S. Treasury bonds will inevitably decline. Countries are increasingly looking for alternatives, whether through bilateral currency agreements, regional payment systems, or even the creation of new reserve currencies. This shift away from the dollar could accelerate if the U.S. continues to escalate trade tensions and push for policies that alienate its key allies and trading partners. The U.S. is now in a dangerous situation. The Federal Reserve has raised interest rates to control inflation, but this also makes U.S. debt more expensive. At the same time, the trade deficit continues to grow, and the U.S. is becoming increasingly reliant on foreign debt to finance its government spending. This is a dangerous cocktail that could lead to a crisis if foreign investors lose confidence in the U.S. economy. If the U.S. is unable to restore confidence in its financial system, the dollar's role as the world's reserve currency will come under increasing threat. As the global economy moves towards multipolarity, the dollar could lose its dominant position. This would mark the end of the U.S.'s financial supremacy and could lead to a dramatic shift in the global financial order. The ramifications of such a shift would be profound. If the U.S. loses control of the global financial system, it will no longer have the luxury of running up deficits without facing the consequences. The dollar's collapse would lead to massive inflation, economic instability, and a dramatic reordering of the global economy. Countries that have relied on the dollar for decades would be forced to adjust to a new reality, one where the U.S. no longer holds the financial power it once did. In the longer term, this could lead to a fundamental shift in the global economic balance. Countries like China, Russia, and others could emerge as the new economic leaders, while the U.S. faces a period of economic retrenchment, the U.S. would have to find new ways to support its economy, perhaps by shifting to a more sustainable fiscal model that relies on domestic production and savings, rather than borrowing from the rest of the world. The world is entering a period of significant economic uncertainty. The U.S. is at a crossroads, and the choices it makes in the coming years will determine the future of the dollar and its role in the global financial system. The next few years will be crucial in shaping the future of the global economy. Will the U.S. continue to dominate, or will it face a decline in its financial and economic power? Only time will tell, but the stakes are high for the U.S. and for the entire world.